The simplest type of investment and the fastest way for the average person to become wealthy is dollar cost averaging. Although this strategy offers investors limitless possibilities, it necessitates very little luck, understanding of investing, or ability to make decisions. For long-term financial gain, it minimises risks and aids in maximising returns. This method is quite effective and couldn't be more straightforward. Let's examine what the term dollar cost average actually means. Dollar cost averaging is a method that entails investing a fixed dollar amount of money on a regular basis, whether it be weekly, monthly, or even daily, regardless of the price fluctuation of the investment. Let's say you begin to invest $1,000 every month into a stock that's price is $100, and just like any investment, the value fluctuates day to day. During the first month, your $1,000 investment buys 10 shares of the stock. The next month, the stock may be priced at $80 per share due to market volatilities. This means your $1,000 will purchase 12.5 shares. Now at month 3, the stock has recovered its losses and risen to a price of $120. So your $1,000 investment only purchases 8.33 shares. When the price of the stock is up, your $1,000 will buy fewer shares, but when the market is down, your money will go much further. This is fantastic because the decision of how many shares to buy is made for you. Over time, this strategy could lower your average cost per share compared to what you would have paid if you had bought all your shares when they were relatively expensive. Setting up a recurring contribution to your investing account allows you to automatically implement dollar cost averaging, which is one of the key advantages. The benefit of investing automatically is that you are more likely to do it consistently over the course of a week, month, or whatever time frame you choose. Without an automated contribution, you're much more likely to decide against investing. Imagine having to decide whether to invest and how much to invest each month. When your paycheck arrives into your account, or whether to forgo investing this week and use the money for bills or other needs instead. Although it would be lovely to use that money for a night out, skipping 1 week won't be harmful to your retirement. However, skipping here could develop into a bad habit that becomes more common. Additionally, when the money is automatically transferred towards your investment account, you're much less likely to notice it missing from your paycheck. Automating the process and planning when and how much to invest ahead of time makes investing easier to do continuously without interruptions. There is no need to be concerned about purchasing at the wrong time by consistently investing the same amount of money. You run the risk of investing right before a significant market downturn if you put all your money into one investment at once. For example, if you had to put all of your money into the stock market in 2007, just before the Great Recession, you would have lost much more money than if you had used a dollar cost averaging strategy and made smaller investments over time. By using dollar cost averaging, you could have started investing in little amounts before the market crashed and kept doing so as time went on. On the other side, in a bull market, you can also lose out on investing at precisely the appropriate time, before the market starts to trend upwards. Imagine that you find yourself with an extra $1 million that you intend to invest in the market, but you are unsure of the best strategy. Should you plan to invest the entire $1 million all at once or divide it up over the course of the following year? You'll remain in the market for a longer amount of time if you invest it all at once, spreading your eggs out over time rather than placing them all in one basket requires a small initial investment. While this is a broad illustration, the best course of action depends on how the market will behave going forward. Of course, if you had a crystal ball and could predict the market would rise steadily without any downturns, investing your entire portfolio right away would be the best course of action. The drawback to this approach is that you have to hope that the market doesn't crash soon after you invested. The majority of individuals don't have a lot of money that they can invest in the market. Instead, they can dollar cost average a modest amount from each paycheck and reap the rewards of that technique. The best action the average individual can take to increase their wealth is to make consistent investments over a long period of time. This entails making investments both when everything is going well and the market is booming, and when everything is going wrong and stock values are plummeting. This makes dollar cost averaging a fantastic approach to accumulate wealth, since it eliminates decision making and reduces stress. A good investor can essentially be anyone who can automate their investing contributions and forget about them. Making the procedure automatic will prevent you from being anxious when the market falls, which many individuals do frequently. They cease contributing as a result, or they sell everything out of fear and uncertainty. When you keep investing throughout market downturns, you can benefit from buying opportunities at all stages of the market cycle. By purchasing both when the market is falling and as it is rising, your chances of making significant gains will increase significantly. Where you can put your money right now to get fantastic returns that will grow your portfolio and allow you to achieve financial independence. There are numerous possibilities, from actively trading mutual funds to picking individual stocks to purchasing cryptocurrencies, but perhaps the best decisions are the simplest. Thanks for watching. Please subscribe for more.